Good day, fellow investors. In this video, I said that dividends can make you rich over time, so let's start analyzing the top 10 positions of the Vanguard High Dividend Yield ETF. Before digging into the stocks, let's just take a look at this ETF that I know many of you are interested in. So the Vanguard High Dividend Yield ETF, the dividend yield isn't that high because it is, let's say, a stable product with very good businesses, as you will see later. They say the risk is 4 from 1 to 5. That's something we'll discuss in a moment. If we look at the things there, the key is the 0.06 fee that is really remarkably low, really great Vanguard product. However, when it comes to investing, you have to see how it fits you. The dividend yield is 2.72%. Which is not bad, but also not great, because there is also risk. And you can see that it declined less than the market, I think, because of the stability and because of the shift towards value. So from that perspective, it currently offers better protection than growth stocks. Let's say dividends offer value. We'll go through the 443 stocks, maybe I'll select them, but we'll do here the first 10. We can see that it is still relatively cheaper than the market with a P ratio of 15, and as I said, the dividend yield of 2.72, which is double than what the market offers. If we look at exposures, we can see that we have consumer discretionary, consumer staples, energy, mostly financials, 20%, and healthcare. And also the top 10 will also be healthcare and financials. We'll go through the top 10 today, but when it comes to dividend yields, especially so distributed and diversified like in this ETF, you always have to keep in mind the treasury rate and long-term stability of that treasury rate, because interest rates are going higher and lower, but these moves are then reflected also in the 10-year treasury. And when it comes to investing, this is the most important price that everybody is looking at, where it will go in the long term, because the fact is now still with treasuries that this is still very negative. You are losing 4-5% real returns here because inflation is 8%. However, if treasuries stabilize at 6%, then also the required dividend yield will not be 2% but 5%. 2%, 5% to 7, 5%. That means that the ETF might crash again 50% to reflect that 5% required return. That's something to always keep in mind when it comes to interest rates and the impact of interest rates on assets. For now, everyone still expects those interest rates and inflation to decline, and therefore they are still willing to pay a good price for those dividends. But that's one risk just to keep in mind, especially on such a diversified portfolio. But let's start with the individual stocks and overview. The first one is J&J. So really great compounder over time, and especially did well since the pandemic as people used more of its products. If we look at the market cap, 465 billion. Keep that in mind. Price earnings ratio a little bit higher than the average, 23, and the dividend yield in line there, 2.55. If I look at the results, really great results there, great brands of course, and 7.9% growth. So all is good with the business. The free cash flows for the quarter, 3.4 billion, which is really good from a cash flow perspective. But if you multiply this on a yearly basis, then you can see that it is not really that great, because adjusted earnings per share are 10, and if you compare with the stock price, it is still far away from, let's say, a price earnings ratio of 10-15. We are a little bit higher here, but still very risky, especially if all the pandemic benefits that these companies had revert. So when it comes to J&J, I think the steady reward is the likely growth ahead. Keep in mind there will always be issues. Maybe the market doesn't see them now, but in 3 years there will be this and legal issues, this and that. It's such a huge business that there will always be something. Keep that in mind. The business is great, but there are always risks, and the risk comes always from the price you are paying for it. If the stock was lower, it was a better buy here than now, especially if interest rates go higher, this will then be pressured lower. For now, we don't see that pressure on the lower, it keeps getting higher and higher, which means the business is doing good, but always keep in mind the risks related to the price versus the earnings you are paying. If they can keep these earnings and continue grow on that earnings as they expect to do over the next years, it will be good. But always when it comes to these big companies, maybe it's better to wait for those terrible situations when everyone is very, very negative about them. So remember here there were some issues with the telcos and everything. Everybody was saying no, too bad. And now we are already 74% higher, plus 5, 6, 7 good dividends. So that is investing in such big stable companies. There will be good times. The market is now very positive about them. That's why it's also at the top at the ETF list. So when the market is so positive, I usually avoid looking into these great companies. Give them to me when the market is negative. Another company, second on the list, and the market is extremely positive about, is Exxon. And you can see here the boom. 2 years, a year and a half ago, nobody wanted oil. It was the end of big oil. We would all be flying around in electric drones. And now the stock has tripled since. So really great performance. But now it starts to go down a little bit as the markets expect recessions. However, market cap is 385 billion. Dividend yield is 3.85 in great times. Now, I made an analysis how I don't like really Exxon, how I feel it is the worst of the big oil, but I also discussed big oil, and this was in October 2019. I was pretty okay with that. October 2019, the stock didn't do much since then, 20% up since then, but I also made videos here about how it's time to invest in oil, because the time to invest in oil is when nobody likes it. So we can see here 9 October 2020, buy oil stock at historical lows. So the time to buy oil stock is when nobody likes them. And now, unfortunately, again, the thing is the opposite. Everybody likes oil stocks. But if we look deeper into Exxon, we can see that they are making huge amounts of cash now. Really, cash from operation 50 billion. They will likely invest 20 billion, especially on high oil prices. They will make even more. So the free cash flow for 2021 was $38 billion. However, they all also, when you look at the projections, you can see here the small dots, they are predicting lower oil prices for longer. That is inevitable because the trend is negative and has a headwind. But when it comes to investing, if they get to an average oil price, which should be around 60, even that was a positive 2 years ago, but if it is around 60, they will not make 40 billion. They will likely make 20 billion. And if you compare that 20 billion long-term average with the current market cap of 400, that's extremely expensive for oil prices and oil-related investments. You have to buy those when everybody hates oil. When oil is in the dumpster, then you buy and then you play the cycle, because it will inevitably revert, because the demand is not as destroyed as those expecting you to fly in drones. So there is always the balance. Now I would stay away from oil, even if it looks like oil prices will be higher for longer given the instability, the geo situation, everything, but I would still say that it is too much risk now for me. Now, JPM, I made this video discussing how I don't invest in banks and financial institutions because I don't want to make it my circle of competence, but let's just take a quick look from the fundamentals and what what is the risk and reward. If we look at JPM, you can see how it really benefited from all the mumbo jumbo going on in the markets, the IPOs, the trades, the merger acquisitions and everything. And you can see how net income really went from 20-30 billion to almost 50 and now expected 40, already a little bit declining as the markets are retreating. But you can see here they make a lot of money from different things, so from interest, from trust income, from mortgage banking activities, income from trading activities that should likely go lower. So there is a lot that leads to their income, and as the activities go down, that is inevitably that also their revenues go down. And you can see here the revenue per share, how it increased, and also the earnings per share, how it increased to the peak of 15 in 2021, and now it's already declining for the trailing 12 months. And I think it can revert in normal times back to what it was 2017, 2018. And if you take, let's say, 8 average and then compare it to the situation, then you see that, okay, the price earnings ratio still isn't crazy. Now it's 8. If then it will go higher a little bit, likely go to, let's say, 15, but 15 is still a bit expensive for these banks. And then there are always the risks of financial meltdowns, even if the Fed will likely save their behind. Now it's a much better buy than here, and I remember YouTube videos being excited here, JPM so cheap, price earnings ratio of 10. Well, you see that the market anticipates now weaker things, and now it's a much better buy than it was here. That is for sure. But the returns will depend on financial action activities going forward, which is then the risk and rewards. And with banks, you never know what is the black swan there, so I simply stay away. Another great business, great brands, Procter & Gamble. So we all know that they have 66 consecutive years of dividend increases, which is really remarkable and makes them a dividend aristocrat. And you can see that growth is continuing, so nothing bad that earnings per share are still growing. There will be now a little bit of inflationary pressures on the costs, but the company keeps on increasing its dividend, really doing great. 132 years of dividend payments. And keep always in mind the following. It was bad. When I remember looking at this 5 years ago, the outlook was bad, and then they managed to turn it around, especially during the pandemic. But again, you can see how for such big companies, there are also these bad periods. And if we look at the stock price, you can see here again, great company, great brands, bad periods. And you always want to get these companies in these bad periods because this is when the reward is higher and the risk is lower. Now, after great years, great earnings, now the market is already contracting a little bit, but it is still risky. Price earnings ratio is 25 and the dividend is 2.57. So that is, again, let's say higher risk and lower reward from these levels. Yes, the portfolio is great, so you can't go wrong because it is a great business. But again, if this just a little bit contracts or interest rates go higher and the market expects higher rates, then you have again a risky situation. And if we look at the table, cash flows are really great, 18-19 billion, so nothing wrong with that. Capital spending pretty stable, which means that free cash flows will likely be 15 billion ahead per year. Compare that to the market cap, still extremely expensive. So yes, quality, but expensive, and that's why they put it at the top of the ETF. So number 6 is another oil stock, Chevron, and we discussed it as Warren Buffett bought big in Q1. And the funny thing now is that Warren Buffett started buying here after the invasion in Ukraine, but now we can see that we are almost back, likely there to what Warren Buffett paid. So if you want to buy something at the same price Warren Buffett paid, then you have your opportunity now. So the market is now expecting, let's say, some demand destruction because of higher oil prices that should lead to lower oil prices. However, when I'm looking at Chevron, if they have, let's say, an average oil price of 75, they will make around 70 billion in free cash flow for this 4-year period for buybacks, and they will also make 50 billion for dividends. That's 120 billion that should be returned to you. If I compare the 120 billion divided by 4, that is 30 billion per year, and compare that to the market capitalization, then you see that the actual return is around 10%. Now you might be excited, Sven, 10% is a great return. What's wrong with Chevron at these prices? Well, oil prices are really fickle. So 75, yes, but what if it is 50? What if it is 60 or 120? Then Chevron will make a lot of money. But now everyone is excited, or was a month ago, now it's already subdued a little bit, about those oil prices. And again, buy oil when nobody likes it, when it looks like we will never use oil again, because the trend is declining. So that's also something to keep in mind. It is a gamble, and I don't really like gambles. Even if Warren Buffett took that gamble, he is looking like it's better to own Chevron than keep the money in treasuries for inflation protection. You will likely get a good dividend ahead. Even if oil prices aren't high, they still will maintain the dividend. But if they just stick to the dividend, this might go back to 7% dividend, which then leads to a 50% decline in the stock. So that is the risk of investing in oil stocks. There is big risk now compared to what happened in the past and how those things evolve. So really watch the cycle and get out in time if you are long. As we said, with oil stocks, this video maybe discusses it because there is sentiment and there is reality, and demand is going higher on low investments, which might keep oil prices higher, but that is then again a might. Now, if you want really good dividend stocks, I am a dividend investor, I like them. Maybe I'm not focused on current dividends, I like them growing and maybe 5 years down the road, because then you get a high dividend plus stock appreciation. Please check my stock market research platform and what I do for maybe some more spicy things that might spice up your long-term dividend investing portfolio, some hedging dividends, so really a little bit more crazy than the 10 stocks we are discussing here. The link for the video explaining my research platform is in the description below. Now, another stock, Home Depot. Yesterday we discussed Stanley Druckenmiller, and he said how retail is still looking good, but it should be hit, and that's what we see in the destruction of the stock price. So Home Depot did really bad since the beginning of the year. It is down 34%, and that's because it really enjoyed a great time during the pandemic where you could not spend going out for drinks, so everyone was spending their money in retail, and now it's likely that it will revert to normality here. And I also said in the last video that I want retailers at 5% dividend yield, so there is still 50% down from here for me. Pfizer is a pharmaceutical. Again, banks and pharma is not my circle of competence, but it is interesting to look at what's going on. Now, they did really good, but this should revert, as I hope that their vaccine as a service subscription will not work, because that's what was their goal, to have us jabbed every 2 minutes. But if they do it, then the stock is then again cheap. But if they don't, this should likely revert a little bit to the mean. So earnings per share adjusted around 6, which still keeps this extremely cheap. But there is always risk with these pharmaceuticals. Their patents expire and this. So as I said, I'm not a specialist, but I know that even Warren Buffett dumped pharmaceuticals recently, so that's also something very interesting. The dividend yield is 3%, good company, they do their job, but I really don't know how to assess this and what will be the long-term cash flows. They always have to invest in new things. They will now acquire this for 10 billion total, so it's not really that the cash flows immediately reflect into shareholder returns, because they constantly need to replace new drugs and keep market share, and that's why it's always fickle to invest in these companies. Another similar pharmaceutical, Eli Lilly, great earnings per share, expected a little bit lower now, but if we look at the stock price, we can see here that the situation here is totally different than Pfizer, because the market is extremely exuberant about what will happen next, and that is unfortunate, but they will make you thin and make you skinny. I don't know, I think that if I eat less and if I exercise more, I should also lose weight, and I'm doing that, but maybe there is a magical pill to do that. Ooh. Nevertheless, apart from the jokes, for now it works, and if this works really and they are allowed to really sell it, you might go to McDonald's, stuff yourself, just take a pill and lose weight. Imagine how that would work for the global population. But this is pharma. I don't like the sector. I hope to avoid it in the personal life, so not for me. But now pharmaceutical stocks are doing good, and that's why you find them at the top of the ETF. Now when the risk is high and the rewards are definitely lower. Another stock that is there now because it's doing good is Bank of America. If we look at the dividend, 2.64, earnings always look good, price earnings ratio looks good, but we know what happens when there is a crisis to these stocks. And the market is already expecting a recession, and when a recession is expected, this looks ugly. So again, now for me, simply too risky to invest in bank stocks. You really should know how to do that, and I, as I said in the video, don't know. We'll put the video link in the description below. Another company is ABBV, $14 expected earnings. Another pharma company, price earnings ratio just 10 with the expected earnings, so their earnings have increased. But then again, you can see here how the market sometimes starts hating those businesses. Depends on regulation, depends on everything. Very complex, too complex for me. I just look at the stock price and I know that you're buying them high. And also if we look at Warren Buffett's activity here, he purchased them low, and as those went higher, he sold everything, I think. So now it is a little bit too risky. We will continue here and look at the other 433 stocks to find those that offer better reward and lower risk opportunities. The top of an ETF, and we'll discuss tomorrow about investing in ETFs because I know you will want to hear my opinion, is always the most expensive at that moment, which is usually the riskiest stuff. But I wanted to give an overview to start here and then give a perspective. If I would have to put $1 million into this, you would have to shoot me because it's simply too expensive now, and I don't want to gamble with $1 million. And this also gives us insight into what sectors are expensive: pharma, big oil, finances, because those are now still holding, but the risks are there. So unfortunately, nothing special here, just that these are good companies, great businesses, however, a bit pricey. That is the conclusion that I got from this. I look forward to drilling down through the list of all of them, and I hope we'll find something interesting. Subscribe, because it will be a nice exercise. Thanks for watching. I'll see you in the next video.